Well, I'd like to, first of all, thank the organizers for having me, for Amanda, Dave, and Dawn. It's very nice to be here in Pittsburgh today. Also like to say thank you to all the activists that were on the streets today, protesting and handing out literature about the Federal Reserve and spreading the truth. And as Gandhi liked to say, you know, what we should be is be the change that you want to see in the world. And I think that it says something that we have people out there that are working to educate everyone else. The presentation I have today is to complement Joe's, and it goes into a little bit of detail on sound money and into the different iterations of monetary systems that we've had since the Federal Reserve began. And then I'll conclude by talking a little bit about the solutions to, you know, not just end the Fed, but also, you know, then what? How do you transition from what we have now to a sound money system? So let's first ask ourselves a question, a very simple one. What is money? And usually when you ask people, you'll be like, well, you know, it's the stuff that we use to go and buy things. But that's not really the whole answer to that. What money is money is an invention of mankind. What it is it's a medium of exchange used, or a unit of account or store of value in order to purchase things or to save and what have you. And money evolved, is also known as indirect exchange, which evolved from direct exchange. Another word for direct exchange is barter. So if you had, I think this example is if you had oranges and nails back in the day, if you wanted to trade your neighbor for whatever, that's what you would do. Now over time what happened is different goods would evolve and be used to buy multiple other goods. So for instance, if you go back to, say, for instance, the Roman Empire, sometimes they would use silver to purchase things, sometimes they would use gold to purchase things, and sometimes they would also use salt. Like the legionnaires in the Roman army were paid in salt, and we get the phrases today like, you know, worth your salt, and even the modern word salary is derived from that point in time. And salt back then was a commodity that was used, you know, either as seasoning for food, but people would also store it and use it as money. There's 4 types of money. The first type is commodity money, like what I just mentioned, whether it's like you had in World War II concentration camps, you had people that used cigarettes, for instance, as money. It's any type, commodity money is any good that is exchanged. And then the second type of money is receipt money. So if I write down on a sheet of paper that I owe someone 1 ounce of gold, and I really have that 1 ounce of gold somewhere, then that receipt, which may be in the form of paper, is really equivalent to that good, although it's not the actual physical form. The third type is fractional commodity money. And what fractional commodity money is, let's say, you know, I still had 1 ounce of gold, but instead of, let's say, having 1 receipt issued out for 1 ounce of gold, let's say I give people 100 receipts. And obviously that would be fraudulent, and in today's world, what the Federal Reserve is really doing is exactly that, fraudulent money. The fourth type of money is fiat money, which means literally by decree. So you decree that this money here, or this piece of linen, is worth something. And that's currently our entire monetary system. Doesn't matter if you live in Thailand or China or Russia, everyone uses paper money that's issued by these governments. Now what's important to realize is that if we just woke up today and let's say we were using other things as money, and the government decides all the time to create something called the dollar and issue it out to people, people would be very hesitant to accept it. So what happened over time is we gradually got to the point where we are today. Okay, there's requirements for sound money. First of all, money must be durable. What that would mean is, like, for instance, if you use something like food or butter as money, it would go rancid and wouldn't be very durable. Meanwhile, you know, metallic coins are fairly durable, and even societies like Japan that would use rice as money, it could be saved for a certain period of time. Second, it must be portable. Like if you have a big hunk of iron to trade around as money, it's not very very convenient to take it around with you. Third and fourth, it must be easily divisible, and it must be recognizable and uniform. So you could take something that's fairly valuable, whether it's gemstones or diamonds, and the thing is that wouldn't really meet the requirements for sound money, because why? And each diamond is different, and you wouldn't be able to divide it up. Like you can't take a divided diamond and slice it in half. Fifth, money must have a stable purchasing power. And as Amanda was talking about at the beginning, against, like our dollar used to be pegged to gold. And this 1 ounce of gold back in the day was about $35. You could exchange 35 paper dollars and get an ounce of gold. These days, gold is trading between somewhere around $1,350 or $1,400 per each ounce of gold. And again, it's lost about 98% of its purchasing power. Next, money must be scarce. For instance, cigarettes that I mentioned that were used in concentration camps, as soon as the war ended, it didn't work anymore, because obviously you still had cigarette factories, and that could very quickly eliminate the scarcity factor. And seventh, sound money must be reproducible. You must have some way to create more of it. All right, and a little bit of a history lesson that Joe touched on for a little bit. Not only was our Revolutionary War fought mainly over not just sound money, but also the excessive taxation and the lack of political rights of our forefathers. But we fought for a reason, and to pay our army for 7 years when George Washington was in charge of our army, he did pretty much the same thing. We would print up money. These were called continentals, and they were used to pay off the soldiers. And these continentals were not backed by anything. And to this day, we still have this phrase that many people, maybe you've heard of it, maybe you haven't, but a lot of people don't even know the origin of it. And worth less than a continental meant that the period after the war, they had printed up so many of these continentals to pay the soldiers that it wasn't worth anything. People would not accept it, or they would accept very high amounts for whatever goods that there are. And keeping this in mind, the Founding Fathers, when they wrote the Constitution of the United States, they had things very much in mind, because what things had happened is, people lost value in the money, and there was quite a bit of chaos. And what they decided to do is that they gave Congress had, this is a direct quote from the Constitution, the Congress shall have the power to borrow money on the credit of the United States. However, notice that what it does not have is it does not have the power to print money. It does not have that at all. And next, Congress shall have the power to coin money, regulate the value thereof in a foreign coin, and fix the standards of weights and measures. That's kind of a, what do they mean, like, fixing the standards of weights and measures? What they did mean is, at the time, they defined a dollar as about 24 grams of silver. And that's what they meant by selecting the weights of measures. And it really came from, like, if you ever hear the phrase, like, pieces of 8, our dollar was based on the Spanish milled dollar, which was came down from the German coin, which was also called the Thaler, which is where they got the word dollar from. And then also, no state shall coin money, emit bills of credit, or make anything except gold and coin a tender in payment of debts. As a matter of fact, the Coinage Act of 1792, it also had, if anyone were to mess around with the fineness of the coins, or would dilute the weights, it wasn't just that they were bad people and would go to prison. The Coinage Act directly reads, they shall suffer death. So that's how the Founding Fathers took this very seriously, because they knew once people start messing around with the money, things will all kind of go very south. Things will go south very quickly. Then the penny, which was and later nickels, they were forms of copper-based fractional money. And these were, if you had 100 pennies, you could redeem them for a silver dollar. But the silver dollar would always be held. And at the very start of things, it was actually held in direct amounts. Now, one of the interesting things about nickels, if you want to make one of the ways to make an instant 26% profit is if you go into a bank if you buy a $100 box of nickels, they'll give you a nice little box. That box of the box of nickels there, that $100, is worth, just for the metal in it, which is 25% nickel and 75% copper, is worth about $125 just for the metal. Now the government forbids you to smelt it, so don't leave here saying, oh, you know, I could leave here and smelt it down. But the whole thing is it's not the money, it's what the government is doing is they're devaluing the currency by printing more of it. And they print money, the worth, every single dollar that's out there is worth less and less and less. And again, money was the mass of silver or gold. And again, if you go into the Constitution and read certain parts of it, in it, the Seventh Amendment, and one where it says that you can't put an import tax on people with $10. These days, we read the Constitution and we're like, that's absurd, like $10, $20. But back in that day, the dollar, again, equaled a certain mass of silver. And if you look at the mass of silver, it's still fairly comparable. All right, next I'll go into the different types of monetary systems that we've had really since the Federal Reserve began. And since before the Federal Reserve, we also had this system that was known as the classical gold standard, and the rest of the world was also on it as well. And this was a fractional commodity money, meaning that for every receipt that was out there, it wasn't backed one for one by gold or silver held on deposit. There was excess receipts out there. The Federal Reserve Act was passed in 1913. Europe, following the inflating of their currency during World War I, completely went off the gold standard. And in 1933, as Joe had mentioned, FDR confiscated the people's gold. And then a month later, he outlawed the gold. Now, one of the things that is also a little bit interesting is it wasn't like the people gave back all of the gold. People were smart enough to figure that it wouldn't be a good thing, and they didn't quite trust the government even back then. And only about 20% of the gold coins that were in circulation were returned. But then a month later, when gold was outlawed, it became quite difficult to use this. What FDR was really doing was making everybody outlaws. So that was the federal, that was the classical gold standard, where you had a direct tie to gold. You could go to any bank with these paper dollars that would say, you know, payable to the bearer or whatever weight of gold, and they would give you the gold. Next, from 1933 until 1971, the United States was on what is known as the gold bullion standard. This was a fiat monetary standard in that since, again, gold coins had been outlawed, and they still pretended it was tied to gold. They set the value of gold at $35 an ounce. And the only people that could get at the gold that was held on deposit was foreign central banks, mainly, and very large transactions. So foreigners could get the American people's gold, but the American people themselves could not do so. And private gold purchases were outlawed up until 1975. From 1975 on, they were allowed. So fractional reserve banking existed from 1971 to roughly the year 2000. And there is no backing whatsoever to it, and it's what they call pure fiat. Again, what we have right now is the Federal Reserve just creates dollars, and then you have a dollar supply that goes on top of that. What I like to spend is a little bit of time. I was going around the room talking to a few people, and I kind of assume a lot of people here are pretty familiar with fractional reserve banking. But so here's how there's two plateaus. One is the dollar supply, which is created by the banking system, and second of all is that the Fed can actually create money. So first of all, how the banking system does it is if you have let's say you have a paycheck for $100, you give it to the bank and make a $100 deposit. The bank tells you, okay, sure, you can take it out whenever you want. But what they end up doing is they end up loaning, let's say it's 10% fractional reserve, they'll loan out $90, say to Joe, since Joe's convenient. Joe takes that $90 and goes off and buys a bicycle or whatever with it, and eventually that money goes back into the banking system. So we still have $100 in the system, But what happens is when that $90 goes back in and is deposited, the next bank, or even the same bank, will keep $9 and loan out $81. So if you look at what had just happened, we started off with $100 that I started with, and now we have $181. And, sorry, $190. And if we just keep this cycle going, we do this again for another iteration, we're up to $271. And if you do it again and again, what you eventually end up with, after about 15 repeats, is very close to $900, and after 40 or 50 repeats, it's pretty much completely done. So within a short period of time, now in modern life, you know, this was a theoretical example, but today on Wall Street, what a lot of these banks will do is they'll just shuffle from bank to bank to bank, so they can do this very quickly within a matter of days. And again, when you talk to people for the first time and try to explain this to you, it was the same thing when I had first heard of it. It really seems like a bunch of nonsense. It doesn't seem like this could actually be possible. But that is unfortunately the way that our current monetary system works. Second of all is how the Fed creates money. And the Fed itself can also create or destroy dollars, but they don't even require deposits to be made. One of the, and I would say probably the key way that they're doing these things is something called open market operations, where the Federal Reserve can purchase or sell any type of asset. It could be real estate. Typically in the past it had been United States Treasury bonds. Recently, as we get into the past several years, we have the Fed buying bad mortgage-backed securities. About $1.1 trillion on the Fed balance sheet right now is pretty much bad mortgages. And also AIG, you have these toxic debt and derivatives that the Federal Reserve has purchased. Next is, you know, and this is just really the rough schematic of what it does. First of all, what the Federal Open Market Committee will decide is, you know, we need more money. And this would be the same thing as the quantitative easing that is in the newspapers that's being talked about. This is pretty much how it works. They decide that they want to purchase $100 billion of Treasury bonds. Now, how do they create this money? They would literally just write a check to themselves. It would be the equivalent of, you know, me writing on a piece of paper, here's 10 Jake bucks, you know, go try to buy a burger with it. But again, this comes from nowhere. This Fed check, now what the Fed could do is they could pay it directly to the Treasury, and then the Treasury would finance its government operations, whether they're bureaucrats' salaries or stimulus plan or bailouts or warfare. But they don't do that. What they do is they sell it to what are known as primary dealers. And these primary dealers are on Wall Street. It's done through the New York Fed. And these will be companies such as JP Chase or Goldman Sachs. And they'll, of course, make a little bit of a transaction fee on it. But what they'll end up doing is they'll buy it, they'll purchase it, and then this money then is still $100 billion, and then the dealer will deposit its $100 billion Fed check that was created at a commercial bank, and then through the slides I just highlighted earlier, very quickly they'll shuttle the money back and forth and expand the money to whatever level that they want. In this example, 10% fractional reserves would be $1 trillion. All right, so I did say that in the year, roughly the year 2000, things changed. And currently, the regime that we live in is, I would, you know, pretty much call it ticket printing. And the way that this scheme, the latest scheme of the Federal Reserve works, is what they'll do is something called deposit reclassification. And what deposit reclassification is when you open a bank account, whether it's at Citibank, Bank of America, or your neighborhood bank, somewhere in that fine print, you know, the print that nobody ends up reading, is something called deposit classification. And what that does is it takes your checking accounts and it creates two sub-accounts. Now, when you get your statement, it will only have one line item. However, on the bank's books, they will have a sub-account for, you know, what's subject to fractional reserves, and they will have a sub-account that is not subject to fractional reserves. And this other, I should probably explain this real quick. This is left over from the Monetary Act of 1980 that controlled, reduced really the reserve requirements. Net transaction accounts is more or less, to keep it simple, checking accounts or now accounts. And that was set to 10%. And non-transaction accounts, which would be time deposits, like if you have a CD or a savings account, was eventually dropped to 0. So even right now, there's a 0% on savings accounts. So what that means is when you give the money to the bank, they can do whatever the heck they want with it. If it's in a checking account, what they will do is this deposit reclassification trick, and literally every day they can change the amount that they want. So this whole problem is, and helped lead to the financial crisis and really the depression that we're in currently. And I do have an article on this that's all sourced, but if you take a look at the banking system before or just before the breakdown, you had roughly the FDIC reported domestic deposits was about I believe that's, I want to say this, that was that would be $7 trillion. The monetary base was 800 billion, and the total reserves that were required, or that the banks had, was $45 billion. So they were really at, if you divide this number by that number, they were at about less than 1% reserves, and that's a rough estimate. It's not going to be exactly correct. But by the middle of July 2009, when the Federal Reserve pumped in $800 billion of liquidity or of new money, most of this just went into jacking up the total reserves of the system. So on paper, they look better because they just filled in the hole. And the monetary base expanded by $800 billion. And lo and behold, the estimated reserve ratio is once again over 10%. So that is something that's not completely well known, but this is pretty much what we've been under since roughly the last 10 years or so. And then lastly, I'd like to go a little bit into, well, one slide on how the Fed causes the depressions. And the way that this works is what they call it is the Austrian theory of the boom-bust cycle. And the way that the Federal Reserve creates this is that they control the interest rates, and what they'll end up doing is they'll drop interest rates, which will lead to a boom. And by doing this, they'll create a whole bunch of credit that businesses will go out and expand with. They'll lengthen the structure of production, which is another way of saying is, instead of providing consumer goods, they'll try and provide goods and services, or if you think of it as like R&D over a longer time window. But unfortunately, what's happening is what these things are called is also malinvestments. And these malinvestments are these entrepreneurs have gone out there, they've started a business or what have you, and there's no customers for it because there's no savings left. And what ends up occurring is you have this crash. So we have the boom, and then the tech stock crash. Then during 9/11, we had the boom in the housing market. Then we had the final bust, and this actually ends in I believe April 2009. But this is pretty much just a straight line out here for a little bit longer. And what we have right now is a depression. Eventually, what we have right now in the Treasury market is this giant bubble. So the Treasury bubble, which is in other words saying the dollar, will go into crisis eventually. All right, so that's kind of the sad stuff. And the whole thing is, how do you restore sound money? And what you can't quite see here is I gave a talk in Philadelphia last year about this time that went into a lot of detail on how to transition from what we currently have back to sound money. And some of the ideas that is there is, to open the mint to free coinage of gold and silver, to remove all taxes on the exchange of gold and silver. Currently, there's capital gains taxes and that sort of thing. So they just try to make it more difficult to trade. Revoke and forbid legal tender laws, because again, the whole problem is that the government tells you that you must use this little slip of paper as money. Then what we really need to do is to help drive debate on a new monetary system. And what I believe that entails is to phase out the Federal Reserve. And again, this is a proposal that I have. But the way that I believe that would work out best, very simply, is you phase out the Federal Reserve, move everything back to Congress for a certain period of time, And you really don't gain too much by that. Like the currency would still be fiat currency, would still be unbacked. But what you would gain is you wouldn't have the bankers sending all this money elsewhere, and you'd have transparency to the American people. And then what you could move on from there is you could phase out Federal Reserve notes and have United States notes that are issued for a certain period of time. Meanwhile, by doing all these things, what it all comes down to is that the people should be deciding what is money, not the government. And when you allow people to trade freely, the market will eventually correct itself, and eventually what would most likely happen is these fiat notes would be phased out over a period of time. So I'd be happy to take questions on this. This will be up on my website, which is Towne with an E, forcongress.com, probably by Monday. And as Amanda had mentioned, I was wondering if I could just, is it okay for like 2 more minutes?
Oh yeah, keep going.
Okay.
As long as you
I'll finish up real quick here with 2 slides. One is to highlight the difference between Keynesian economics and Austrian economics. And in Keynesian economics, and we have, Mr. John Maynard Keynes here with one of his famous quotes, and some of his quotes are pretty darn funny, but in the long run, we're all dead. And the whole idea of Keynesian economics is that the money power belongs to the government and to the bankers. It does not belong to the people. The government commands the economy, which now is finally into the open over the last 2 years since the Chart banker bailout, the purchase of GM, and all the auto industry and the banker bailouts. They're renowned for deficit spending. They usually can't balance a budget, and the whole idea is, well, if you're in a depression, the government needs to spend a lot more to bring us out of the depression. And also stealing by currency debasement, which is another word of saying, for inflation, we print up money. It makes everybody else's dollars worth less. They redistribute wealth to the military-industrial complex, which funds our wars. Banking cartels, special interest groups, and corporations. It allows and rationalizes the government to take over private businesses. And it also, and a lot of times, you might say, well, it's the free market or it's capitalism, but only really in word. In true, indeed, what it really functions as is either crony capitalism or vulture capitalism or the corporatocracy or disaster capitalism. It has nothing to do with the true free market. Austrian economics, and one of the, I would say, probably one of the last greatest economists of the last century was Ludwig von Mises. I studied there in 2009, and you can go to the website, which is mises.org, mises.org, for anyone interested. And they have a ton of audio, and I think Joe, you actually mentioned this as well. Free books, you can just download there in PDF, but you can read off of the computer, it's okay, or you can order the books as well in print. But in Austrian economics, the people own the money power. It's not the government that has ownership of this. The government plays no role in government planning, in economic planning. They do have a role in the rule of law, and making sure that acts of fraud and aggression and murder and such are responded to. But also promotes honest money and balanced budgets, and it highly rewards those who create wealth and shares it with everyone, instead of having these select cartels. Government, no way, or will never take over private businesses. There's absolutely no need for this. And we'll also promotes free market capitalism and laissez-faire, which is French for let them be economics. Like the markets will always clear. They don't need the government messing things up. And when you go through the last decade and back even further, government tends to do exactly the same opposite things to prolong this depression. So instead of having a very short and possibly fairly sharp recession, we have this long drawn out and delayed depression. And we aren't going to get out of it until we start changing things, and that's why it's so very important to spread information and share these things. And that's why it's very much an honor and privilege to be talking to a group that is very much an activist organization. So thank you very much for your time.